Great to be back again in front of you. And this time, as Rachel said, I'm going to do a little bit of a jargon busting tour of how to buy shares and introduce the roles of one or two people in the city, and also explain some of the decisions you need to make if you are going to buy shares, as obviously a lot of you may be thinking of doing so. So basically, what do we got? Imagine you want to go out and buy 1,000 Tesla shares, let's say. You've just had that thought. You could step outside and see if anyone wants to sell them. But frankly, your chances of finding someone who wants to sell 1,000 Tesla shares, agreeing on the price, trusting them to deliver them to you, them trusting you to come up with the cash, it's a lot to ask. And frankly, doing an over-the-counter, as it's called, or in the street, as I would call it, deal that way, is time consuming and messy. So a better bet is to use the market, whatever that means. Now, using my daughter's props, I've prepared a little diagram to save time here of how the market works. So you're on the left, if you like, as you're looking at that, you are looking to do a trade. So a quicker way of doing it is to go to a broker. That's the slightly podgier person in the middle, well-fed. And then on the right, you've got the market. And the point is the market operates a bit like a club. You can't necessarily join it as an individual investor, but a broker, an intermediary, can. And the club, broadly speaking, comprises of 3 organisations involved in getting from a deal in shares through to final settlement, which is where legal title and cash change hands. So you've got the London Stock Exchange, LSE, that's just a market where lots of buy and sellers are brought together centrally, saves you having to go and find one. And they're all linked together. And basically the London Clearing House then guarantees trades that are routed through the London Stock Exchange. It does that by margining its members. Those are the brokers. Most people don't worry about that as individual investors on the left-hand side, but it guarantees the trade. It stops somebody running away without paying and somebody else running away without delivering 1,000 Tesla shares, for example. And then the Euroclear bit is the bit where you actually settle the transaction. So quite a few big city institutions involved behind the scenes in allowing a broker to do the trades on your behalf. Okay. Now, that then begs the question, what sort of relationship could you have with this person in the middle? Well, the answer is there are 3 types of relationship. Execution only, that's just taking an app, basically giving an instruction, buy 1,000 Tesla shares, job done. You know, talk to anyone, all of that stuff I talked about, the plumbing happens behind the scenes and is part of the commission that you pay. Then there's taking advice. So you could have a phone call with a different type of broker, talk about what you're trying to achieve, build a portfolio, add 1,000 Tesla shares to it. And then the last level is discretionary management, where you basically say to a broker, here, look, here's some money, go away and invest it, taking into account, you know, my risk tolerance and my objectives, and let me know every now and again how I'm getting on. And that's called discretionary management. So you've got XO, as it's called, some sort of advisory relationship, and then full-blown, somebody else looks after my money for me. And the cost of those will obviously vary, but it's not all about the cost. So how would you make the decision? Do I want just an app? Do I want to talk to somebody? Do I want to give them a chunk of my money to look after and run a portfolio? Well, here you go. Essentially, again, using my daughter's high-tech equipment here, you'd have to take into account how much you know about the markets. Do you know a lot? Do you know a little? And you've got to be honest about that. How much interest do you have in it? I mean, frankly, if you've got no interest, but you want to make a decent return, maybe you just hand it all over to somebody else. Who knows? What services are you looking for? Do you just want pure vanilla buying and selling of shares? Or are you looking for other things around the edges? That might influence who you choose. Maybe some of those things are not available through an app, for example. And how much time have you got? You know, are you retired and you've got a couple of hours a day to leaf through the FT, make some informed investment choices? Or are you far too busy for that, frankly? So lots of things go into that decision. You know, shall I just use an app, execution only? Do I need to talk to somebody, get some advice, or would I rather just hand the whole problem over? All right. Now, on that note, what is I talked about the cost of doing a transaction in shares, let's say. There is a hidden cost I just want to mention. So when you buy and sell shares, there will be a commission of some sort, maybe low, maybe a bit higher, depending on the level of service and the broker that you choose. There'll be some fixed costs. So there's stamp duty. You pay that as the buyer when you buy shares. If you ask for certificates, not many people do that anymore, then you pay a little bit more on top. So most people are happy to do this electronically, as it's called. You may have parents and grandparents who still keep share certificates, but an awful lot of people don't worry about those anymore. They're not legal proof of ownership like they used to be in the old days. So you've got stamp duty, you've got commissions, and you've got spreads. I want to talk about spreads because people don't advertise spreads much. What is a spread? A spread is a way for that broker in the middle of my diagram at the start to make money on a share transaction. And it is the gap between the price at which you buy shares through a broker and the price at which you sell shares. And not surprisingly, a bit like second-hand car dealers, they don't thank me for likening them to second-hand car dealers, they're trying to make a bit of money. So if you take a second-hand car into a dealership and say, I want to sell this, they offer you one price, go back 2 days later and try and buy the same car, and mysteriously, the price has changed, not in your favor. Okay, well, share trading works like that. There is a mid-market price, which is what you see in the FT, for example, or on a screen. And then around that, you've got a price at which shares are bought and sold. And you're going to pay a bit more as the buyer to a broker. You're going to receive a bit less, if you like, if you're looking to sell shares. And that gap's important. It can be quite narrow on heavily traded, very liquid securities, FTSE 100, for example. But if you're looking at less liquid shares, shares that are not traded as often, that spread not only can be fairly significant, it can eat into the overall profit you make on your trade, because in effect, you are buying high and selling lower, if you like. And it's worth, therefore, kicking the tires, asking the question, how much is the spread? And also, will it move? So liquidity, if you like, the ability to trade an asset influences the width of that spread on shares, on certain types of fund, on all kinds of assets. So it's important to also track how that's changing over time. It might not change very much on a very liquid, popular share, but on something less popular, less liquid as the market calls it, it could move. Now, let's say you're all set up, right? You've decided you want to go out and buy shares. You've got the broker you like, whether that's just a simple app, whether it's a human relationship because you're going for an advisor or a discretionary management arrangement, as they call it. You understand the costs, you're ready to go, you feel informed, you're up for it. What are the classic mistakes that lead investors not to make as much money as perhaps they should, even relatively well informed? Well, again, no expense spared here. I'm going to hold up some post-it notes with 4 of the most common investing errors I tend to come across. There are loads more than 4. Happy to tell you about those in another conversation. But here's one. Okay, told you it was high tech. Gambling, not investing. Now, this tends to happen where people use apps to bet on single stocks. Single stock investing is dangerous. I've talked about this before in the context of Robinhood and GameStop and so on, but basically single stocks, that's not proper investing. You want a diversified portfolio of stocks that will behave and respond in different ways potentially. Otherwise, you're leaving yourself really tied to the fortunes of one management team and one company. So I call single stock investing gambling, not investing. Then here's a big one, market timing. I was talking to the UK's most arguably successful fund manager last week, Terry Smith, and he said, he's been quoted many times as saying, there are people who know they can't time the market, and there are people who haven't found that out yet. And essentially, market timing is people being a little bit clever. And I saw this actually, I couldn't believe it, I won't name names, in a national newspaper recently, famous commentator saying, I think it's time to take some money off the table in America. I was like, how can you possibly know that? And he even said, in May. I was like, crikey, I don't know what you're drinking, but I'd like to have some of it. So people who try and time the market are usually disappointed. It's incredibly difficult to do because you're trying to beat professionals, algorithms, your friends down the road who know a bit more about a particular stock than you do, all the professional analysts out there. And some of my best friends are analysts, as they say, and they get it wrong. So heaven knows, what chance most of the rest of us have got. So basically, market timing's another no-no. 2 more to go. Here's one. And you might think, cool, he's got a cheek with this one. Ego, all right? Ego is basically overconfidence. We all think, and this has been tested in straw polls, you'll be sitting there thinking, I'm not overconfident. I bet you are. There was a period in my life where I thought I was an above average driver. I still think I'm above average driver, but by definition, not everyone can be an above average driver. Equally, I think I can hold my beers. I think I'm better at holding my beers than most people out there, but by definition, that's probably not true. We can't all be above average. And in trading terms, overconfidence can basically lead to people not accepting that they might make a mistake and keeping quiet about mistakes. The people who brag in the pub, God, look at the turn I made on this particular stock, often keep quiet about the one they had a nightmare with 2 weeks ago, because that's human nature. Survivor bias. We talk about the winners, we tend to forget about the losers. And then finally, this is not by any means the last one. These are human emotional biases that get in the way of making money and investing. Anchoring. And people do this all the time. They say things like, I'm not selling this stock until it gets back to what I paid for it. You might think, what's wrong with that? Well, it might never get back to what you paid for it. What if things have changed? I've bought stocks occasionally that have just gone down and down and down and down, waiting a long time to get back to what I paid for it. And people anchor to the past. They anchor to indices and they say, well, back in X year, the index was at Y level. And I think circumstances are similar. But, as the famous quote says, history never repeats itself. At best, it rhymes. So we can learn things from the past, but we shouldn't expect to just draw a straight line through a chart and go, well, X must equal Y must equal Z. It doesn't work like that. So these emotional biases are one of the reasons people sometimes hand over some of their decision making to investment professionals. It's simply that those investment professionals are usually, hopefully, well qualified, fairly dull, and what they'll do is take out the emotion. All right, they may not be the kind of people that you want to dash out to the park with every day, but they are the kind of people that won't fall into these classic investing traps.